On the Spot with Michelle Makori is brought to you by Prime XBT.
Hello, I'm Michelle Makori. Thank you for joining us. The U.S. economy has so far defied predictions of a forthcoming recession. It has withstood 10 interest rate hikes in 16 months, the fastest pace in 40 years, from a very aggressive inflation-fighting Fed. A resilient job market, a roaring stock market, solid second quarter GDP, and lower inflation are all fueling hopes of a soft landing. Well, here to dash those hopes is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com and President of VerifiedInvesting.com. Gareth, welcome back to Kitco.
Thank you so much, Michelle. It's wonderful to be back on Kitco.
All right, we have a lot to discuss with you. Obviously, we want your forecast for the equity markets, for Bitcoin, and for gold. And there is also a commodity that you are very, very bullish about. We're going to save that tidbit for the end of the interview, but let's kick things off with your macro outlook. And you're saying that while we seem to have some solid indicators, they're not quite as they appear. So let's break that down, starting with GDP, gross domestic product for the second quarter. That grew at a seasonally and inflation adjusted rate of 2.4%. That's according to the Commerce Department. And that was, in fact, a faster rate than economists had expected. It was above the 2% growth in the first quarter as well. So very positive there. And consumer spending, which we know is a big driver of the US economy, over 70%, that rose at a 1.6% rate, slower than in the first quarter, but still very solid. And much of that consumer spending growth coming from spending on services like vacation, travel, restaurant, meals, and even Taylor Swift tickets. But your read is that GDP, even though it looks pretty positive, is in fact misleading us here. So talk us through that.
So one of the things that most people don't know, and I didn't know this a year ago or so, is that to get the GDP number, you take out imports, right? So you subtract out imports. And one of the things you'll see if you look at a chart of imports is that U.S. imports have fallen to their lowest level in quite a long time. And so the lower imports go, the less it subtracts from GDP and will artificially raise GDP. So it's not to say that the economy is not expanding, but I think it's a little bit on the false narrative side to say it's expanding as rapidly as people are thinking. And again, if you look at what precedes recessions, a drop in imports is one of those indicators that tells you something is amiss.
Okay, just to play devil's advocate here, couldn't you say, well, that's good because it means more things are being made in the good US of A?
Yes, and that is probably part of it. I don't think that, again, as many factories are up and running quite yet to really explain off all of it, but that is absolutely a narrative that we could take. Again, I think when you combine it with other factors and other economic indicators, that's where it gets really tricky. And just to give you a sense of this, I mean, take a look at consumer confidence. Consumer confidence has been very, very strong recently. However, if I looked at this chart here, we can clearly see, and this is the index of consumer sentiment by income. So income is the dotted line. So that's the top tercile of income. You can see income tells us that consumer sentiment is very high, while the lower portions of income is still very, very low. And what this tells us is that consumer confidence is high, mainly because likely the higher income people have more exposure to the stock market. And the stock market has been on a torrential ripping higher.
All right, let's talk a little bit about the jobs picture then, because that has also been surprisingly resilient. Over the past 3 months, the US economy has added 244,000 jobs per month, more or less. In June, added 209,000 jobs. That's very healthy. Now, granted that labor is a lagging indicator here, but what's your read on what's happening on the employment front?
Yeah, so the employment front has stayed strong. And I think to me, this is one of the last kind of standing poles that's keeping the stock market up, is this belief that there's still a lot of jobs, people can always get jobs, and therefore there's consumers that will always have money in their pockets. My fear is this, is that we went through a period in COVID in 2020 where employers had so much trouble getting employees that now that they have them, they're very reluctant to let them go. And so what you're seeing is this narrative of a soft landing or no landing at all is making these employers say, you know what, I better keep on the sidelines from laying anyone off, because if we reaccelerate, I don't want to spend a year looking for a qualified person for this job. I think once we see the recession hit, which I would still expect late this year, early next year, I think that you'll see a deluge of layoffs coming through. And we've already seen it in the tech sector. Then you also have to factor in the AI boom that's coming. That's going to also lead to some layoffs as well.
Right. Well, speaking of that soft landing, Fed Chair Jerome Powell says he still thinks it's a possibility. I'm quoting him here. We do have a shot at bringing inflation down without a significant downturn that results in high level of job losses. So he's pointing to that strong employment picture as a reason that this recession may not be as bad as people had anticipated. And we are getting mixed signals from analysts. Goldman Sachs economists, they've trimmed the estimated probability of a US recession over the next 12 months to 20% from 25%. But very interestingly, Gareth, we heard from a mortgage giant Fannie Mae, and their analysts there are seeing a recession coming, as the recent data shows that even though it's looking robust, they still see a modest recession in the fourth quarter of this year or the first quarter of next year. Now, you are not on team soft landing here.
No.
It's not going to happen, is what you're saying.
No, and again, the data is clear here. I mean, you can see here, and I'll show some other charts of interest. Here's a chart that shows excess household savings. So we see during COVID, there was a massive increase in savings, but look at it getting depleted. And this only goes to about February or March of this year. And you have to think of where we are currently. So you have that aspect fighting kind of this potential for a soft landing. And then you go to something as crazy as this. And this is a really shocking chart for me. This is the median sale price of houses sold versus real median household income. And even in 2008, the cost of a house was about 350 to 400% of income for a family. You're now even well above that level. So talk about a strapped consumer. The data is showing the average car payment is now near $750 versus in 2008, it was about 350 to 400. The cost of housing or the sale of housing is 550 times the median income. These are all things, and again, I'm not even talking about food and energy prices, which now, since the last CPI report in June, have started to catapult higher. So to me, this is just more indicators. And I want to show you a couple other charts, because I think I'm a big chart person, as you know.
We know.
But look at this. Look at this. This is the forward PEG ratio, so price to earnings growth. The last time we were this high matches the .com era. And again, even higher than 2000 or 2020 or 2008 going into that period. So there is huge speculation. Another chart that I think is astronomically important to take a look at is the aggregate net speculative positioning in U.S. Treasuries. So think about this. Treasuries are now paying 3, 4, 5, 6%, right? I mean, if you go to corporates, you can probably get 6% on something like Microsoft. Otherwise, you're in that 4 to 5% range. Bonds are less attractive to the average investor now. Average investors are saying we are less likely to invest in bonds when they pay 4, 5+% versus stocks now, compared to when bonds were paying, 1% or thereabouts. That is crazy speculation to think about, that you can be offered 5% and still say, no, I much rather, even when I was getting 1%, be rather in stocks at this point. And again, it's just remarkable to think about the speculation going on. The last chart I'll show here, corporate bond yield versus Fed funds rate. And I literally could go on with you for 2 hours showing different charts, but to keep it simple, look at this chart. The red line is average corporate bond yield minus Fed funds rate. The white line is the S&P 500. Look at how every time you're down in this range, it coordinates with a major corrective move in the stock market. So again, here, this was the 99-2000 .com bubble bursting. S&P collapsed. We know, so did the tech sector. Here's 2007 high pivot. There's your rollover for the Great Recession. There's COVID right there. And look at where we are right now. So all of these signals and then some, to me, just say it's great to think that the Fed somehow, and listen, I love being an optimist. I think people in general should be optimists, but let's be fair. The Federal Reserve has never engineered a soft landing in the history of themselves. What makes us think that this time, when things are even crazier out there, that this time is going to be that situation?
There's never been a soft landing.
Not when you have these scenarios where you have this kind of scenario where the Fed has had to hike rates and try to land the economy. I mean, think about 2000. We still went into a recession, right? Think about 2007. You can go back to the 80s and look at all of that. The Fed has never, and the part of the issue is this, is that the Federal Reserve is always following data that's lagging, right? And they also feel the pressure to get in front of the move. So in instance, in the recent periods, they talked about transitory inflation, and they basically were made the fool. I mean, let's be fair. They were so off on that. And so what do? They overreact in the other scenario by following lagging data. And so they overcompensate, which is very normal for all of us humans to do. We always overcompensate when we're wrong in this side, but ultimately they go too far in the other side and kick us into a recession. Now, listen, Jerome Powell has said he doesn't mind a recession, but I would just point out this: 2008 in January or February, Ben Bernanke came out and said, guys, we've looked at the data. There's not going to be a recession. What did we get last week? Jerome Powell finally saying, guys, there's not going to be a recession. Again, I think that to me right there is a red flag as well.
Well, he was a bit more nuanced than that. To be fair, he did seem to indicate that the likelihood of a soft landing is increasing. He didn't say we would not get a recession, but I get your point. Everything that we hear from the Fed has to be taken with a very, very big grain of salt. And of course, I always like to hop back to that transitory inflation comment as well, because it's been anything but transitory. And that's why we have the Fed raising rates so aggressively to the highest level in 22 years. Now, we have seen signs of cooling inflation, at least according to the government's latest data, June CPI at a 2-year low of 3%. But you think that that's not maintainable, that we're going to get higher readings on inflation, and that's going to curtail the Fed's ability to cut interest rates further down the line, which is what the markets are hoping for. So break that down for us.
Yeah, so that's exactly what we're talking about here, is that just looking at the data. And I think it's really important. I mean, it's great to believe in a soft landing, but I think that all the viewers out there, you have to hear both sides and you have to make that judgment for yourself. And I think looking at data specifically gives you a much clearer picture of reality. And if we look at the chart here, this is the chart of oil, right, which is one of the key components. And let's not forget that Jerome Powell said in his last press conference last week that he feels very strongly that they have to tackle food and energy and housing prices, because that's what's hitting middle income and lower income families the hardest. Well, if we look at since the last CPI report came out, which was for June, oil has been up about 15%. So we all of a sudden see a month over month increase in oil of 15%. We then look at something like gasoline, right? Gasoline, another key component of the core CPI here. And this has also had about a 15 to 20% move to the upside. In fact, looking back year over year, you're essentially at 52-week highs. So even year over year, you're starting to see the plateau on inflation dropping. And that's my big concern, is that if you look at what the market hopes that inflation comes down low enough so that if we do hit a bump, the Fed can lower interest rates and print money. The more we see upticks in core CPI factors, including housing, by the way, housing has started to uptick again, the less likely the Fed has maneuverability. Because if you start printing money and we're at 3% inflation when we were at, let's say, 1.5 prior and we went to 9, at 3, where do we go? Do we go to 15%? And the Fed, again, can't do that. And they've said they can't do that.
Right. And on the oil and gasoline front, we did see some artificial intervention when the Biden administration tapped into the strategic petroleum reserves. We can't do that. They were trying to bring gas prices down ahead of the midterms, tapped into the strategic reserves. Can't do that. And we know that they've been very unfriendly to domestic oil and gas producers. So that is also certainly a factor there.
That's absolutely true. And if we look at this chart, this is the Invesco DB Agriculture Fund. Take a look at this, folks. So you bottomed out really last July here of 2022, and look at where it is now. So if you're talking year over year from July CPI, this is the agricultural fund. So it talks about, like, you know, you're talking corn and wheat and so forth. And look at here, this was last July, and look at where we are. So we're now talking about up 10% year over year, not just month over month. And again, the point is, I don't think we're not talking about about CPI and inflation going back to 5 or 10% in the short term, but it's the upticking that's going to make it very tough for the Fed to say, hey, we're not raising anymore and we're going to start easing when the economy hits a snag.
So higher for longer, basically. Yes. Maybe one more rate hike, maybe two.
Yeah, I don't think there's much more upside on rate hikes. Maybe one at most, I think. I think it's more that the market, when we hit that snag, is going to look to the Fed, because that's what we've been engineered to think, right? The Fed is always there to save us. Right. It looks like they're saving us again. So we're all going to look to the Fed and say, hey, could you please cut rates now or print some money? And the problem is going to be that they're going to say, well, if we do that, does it increase the core numbers again? Does oil go even higher? And by the way, there's a double-edged sword here with oil, in that if you aren't going to have a recession and we're going to have a re-energizing of the U.S. economy and, let's say, Europe and China, which is now stimulating, does oil continue up, which then ultimately can force a recession by high oil and energy prices?
Right. But, Gareth, we have been expecting this scenario to hit earlier. People were forecasting that we would start to see this scenario of the Fed raising into a recession, the market's expecting a cut, not being able to get what they want, and expecting a downturn and a major market correction. And most people were forecasting for that to happen by now. Why has that not happened yet?
Yeah, and so I'm one of those people that I thought it would happen a lot sooner. In fact, I thought gold would be the far outperformer for the year. I thought it would even be Bitcoin. Now, we still have time left in the year, and I still think the NASDAQ and so forth will come in. But I've been surprised at how long of a period the economy has stayed strong. And I think there's a couple reasons for that. So one of them is that excess savings from COVID has really played a role in elongating this kind of positive economic period. The other part I would dare say is probably in line with kind of the idea that there's a lag in interest rate policy of 6 to 12 months. If you go back 12 months, the Fed funds rate was only at about 1.5%. And so we're now at 5.25 to 5.5. And so again, if it's an elongated period because of spending and you look at the lag effect of federal funds hiking, then it does make sense why it's probably lasting a little bit longer. And I also think, by the way, coming into this year, all analysts were saying this is going to be a horrible first half, which had everyone on the wrong side of the trade. And so there's been this catch up where fund managers and retail investors have legged in and kind of brought their portfolios back to normal. And I think that's also helped in this run in the stock market.
Right. There's been a sense of FOMO when we saw the market go up. People that weren't in the market were like, well, we better get in here now. And that's also, of course, fueled this rally. Now, Gareth, we spoke about this at the beginning of the second quarter. At that time, you said you saw significant downside for the S&P 500, closing at 3,300 by the end of the year and below 3,000 for 2024. It's what, 4,578 now, up 19% year to date. Your outlook for the end of the year is still that bearish? You still see the S&P at 3,300 by the end of the year?
No. I think at this point that's shot. I think realistically, and you got to be realistic about the charts, is that I do think we will come down significantly, but we're probably looking at some sort of target range for this trend line by year end, which is taking your COVID low to this pivot low here, which was October's low. And my guess is we'll be in the 3,900 range. So I think as a technician, I have to constantly reevaluate the charts. As I said, I think the markets had to have much stronger run, which means that even a pullback to 3,900 is still a significant pullback, but I don't think we start testing October lows or below till 2024 at this point.
But do you still see a 25% drop from the recent highs?
I do, absolutely. I think it'll just be in 2024 pushed out a little bit. And again, it's just, again, looking at the data. I mean, if you look at where valuations are, right? So earnings have not really been expansionary, right? So we've seen these stocks get these crazy valuations, putting them in alignment. And I showed that PEG chart earlier, price to earnings growth, is that we're essentially at valuations that are reminiscent of the .com bubble based on earnings growth. And so you have to look at that correcting at some point. And I think the trigger, there's two triggers. The first one is going to be when jobs finally start to come in. And the second one will be is when we see the Federal Reserve unable or unwilling to cut rates substantially in accordance with that data drop.
Right. So we do have sky-high valuations, very disconnected from earnings and fundamentals here. But if you look at the earnings that we've gotten so far, in terms of expectations, and a lot of the market has to do with expectations, more than half of the companies that have reported so far, 82% topped earnings expectations. That's according to FactSet. Now, I get that expectations is not the same as beating on the bottom line, but so much of the market is driven by psychology and sentiment. What is that telling you?
Yeah, so I think that's the key, is that a lot of it has to do with sentiment. And if you look at 82% of companies beating, but then look at their price action after earnings, I think it spells a bigger picture, right? So for instance, if we look at Microsoft beat on earnings and beat on every metric basically, but we saw a sell-off on that because price had gotten too far ahead of itself. Now, interestingly enough, I want to show you guys this chart. This is just such a cool chart. If you go back to the 99.com bubble high pivot and you connect it to the 2021 highs, that was the high on Microsoft just before earnings. All right. And again, it's amazing how trend lines can go back. I mean, we're talking 24 years here, and that's the exact top on Microsoft. And for me, I look at this and I say, okay, this was a major cycle top with a huge correction. This, going back to 2000, the dot-com bubble, was a huge correction. What makes me think this won't be very similar? Could we have already seen the highs of this bull cycle for Microsoft? And again, we're coming into Apple earnings and Amazon earnings, but it's fascinating to look at these charts.
All right. Well, of course, Microsoft, part of the Magnificent Seven, and the latest leg of this bull market has been driven almost entirely, but by just 7 stocks, that Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Now, you're saying Microsoft has probably peaked. Are any of the Magnificent Seven still looking like a buy to you?
Yeah, that's a good question. So the only ones that we've seen of the Magnificent Seven that have reported so far that have gone up have been ones that have not been at their all-time highs. For instance, Google, right? There was so much fear about Google and AI, and they were behind on the chatbot, 𝗍𝗵𝗺. And that was one where it was a surprise. Expectations were extremely low. They were able to get a pretty significant rally on earnings. Aside from that, you look at Tesla, Netflix. I mean, Netflix, not one of the Magnificent Seven, but that came in sharply as well. And obviously, if we look at something like an Amazon or Apple, those to me are priced to perfection. In fact, Apple has a weekly topping tail, which for those of you that know your technical analysis, as long as this holds into earnings, that's a bearish signal. And I think we have to go back to what 𝗍𝗺𝗬𝗧 said a couple weeks ago. They said that the chips for AI were moving very quickly, but the chips for phones and computers, there was a big slowdown, and that's why 𝗍𝗺𝗬𝗧 missed their earnings. Now, investors in Apple have ignored that, right? I mean, price is virtually at the all-time highs, but I think we have to be recognizing that going into earnings, there could be a little bit of a sell-off on the back of that.
Okay, well, you mentioned chip makers. Obviously, Nvidia, huge story, up, 225% year to date. What's your outlook there?
Yeah, so Nvidia has been a monster performer. And again, now it's trading at something like 25 times forward revenue numbers, let alone earnings. And I think this is the key, folks, is if you look at the same sort of cycle analysis that we looked at on Microsoft, and we look at 2018 where it had its last big dump, and then 2021 where it had its huge dump, let's just connect those highs and see what we get. And look at that, right? So we're virtually into that same trend line, which to me would be a big warning sign. One of the interesting trades here, I'll throw a trade out there. And again, I'm not in this trade, in this pairs trade, but my thought process was go long AMD and go short Nvidia, meaning that if we look at AMD relative to Nvidia, in fact, let's go and do that right now. This is a really kind of a cool comparison to do. In general, AMD historically has tracked Nvidia until 2023. And so if you look at a pairs trade where let's just say it tracks perfectly, there's no loss, there's no gain, but imagine if we see a reversion to the mean on Nvidia where it comes down and AMD rallies to catch it, you could have a beautiful little opportunity there. So just an idea there for viewers out there to think about a pairs trade, short Nvidia, long AMD.
But you're saying you're not participating in that trade?
No, I'm not at this point, but it is on my radar. And they have earnings today after the close. I'm a little bit more cautious going into earnings. I want to see what they report, even though I could miss a move there.
Fair enough. So to recap, on the Magnificent Seven, we're still waiting for earnings, but overall, is your sentiment there that they've peaked? Not much room left to run in any of them.
Yeah, per the charts, majority of them have peaked. Maybe not Google, being that it was lagging, but Microsoft, Nvidia, Tesla, they all look like they've peaked to me. And the macro data, while lagging, I do think the macro data should be something that every investor pays very close attention to.
Right. And as you touched on earlier, that we have a scenario where bonds are paying 5%, safe investments, but there's a higher exposure to the stock market, more bullish on stocks than on bonds. Why is that? Is that FOMO? Is that greed? You have relatively safe investments yielding a very decent 5%. A couple of years ago, you would have begged for 5% from a safe investment. So what's the mentality here? Is it FOMO? Is it greed?
That's essentially what it is, right? It's playing the catch-up trade, being off sides and missing out, the fear of missing out, like you're saying. And we've seen that happen in periods like this. I mean, 99, 2000, 2007, even 2021, there was this disparity that was going on. It just happened to be that yields were a lot lower. But at this point, you can get more than the yield on the S&P 500 in a bond, and people are still saying, nope, I can make, or at least I feel I can make so much more in stocks. And that to me is a big warning sign. We now have the 10-year, for instance, above the inflation rate, which means you're net positive. That didn't happen back a couple years ago. And people, again, are more bullish on stocks now versus bonds than they were back then.
Right. And I know you pay tremendously close attention to market psychology and market sentiment. And to quote the Oracle of Omaha, Warren Buffett, be fearful when others are greedy. I had a conversation with 𝗫𝗐𝗧 Booth earlier this week, last week, I believe it was. She said that in her personal portfolio, she has zero exposure to U.S. equity markets. Mm-hmm. Is that a move that you think people on the long term should be looking at?
I've for the last year, I've been a big fan of Brazil and even somewhat China. China's a little bit trickier because of the Taiwan potential situation. But if we look at the EWZ here, I've had these trend lines on my charts for a long period of time. And if we go to the weekly chart, look at this. So the Brazilian ETF, and this is essentially the Brazilian stock market, it topped out in 2008 and has not even been close to those levels. But look at this wedge pattern and look at what's happening right here. Right, you're starting to break out. So again, I'm not sure if I would advise no exposure whatsoever. I'm definitely a fan of defensive names in this situation and not chasing tech plays. But I do think that foreign markets are a place where money is going to turn to if the Fed is not going to go back to easy money policy.
And of course, Gareth, that speaks to a whole larger trend. We know we have the BRICS, Brazil being the B in the BRICS, Russia, India, China, South Africa gearing up for their big meeting. We know that they're talking about trading in their own currencies. We've already seen that trend continue and accelerate. They're pushing to have a growing de-dollarization sentiment. And collectively, obviously, they're a very big chunk of global GDP. So the opportunities in emerging markets do seem to be there. Now, I want to hop back to when we spoke again, which was the beginning of this quarter, because so much has changed in that 3 months. We did, of course, chat at the Bitcoin conference. But the first time we had a conversation regarding the banking crisis was about 3 months ago. And at the time, First Republic was on the brink of teetering, which it did. And now we have, Fed Chair Powell saying that the banking system is sound and resilient. We've covered that we don't take what he says, at face value. But what are your thoughts on where we are in terms of the banking sector?
Yeah, I mean, the concern is, so number one, the Fed or essentially the government guaranteeing deposits was a big step back in March, right? I mean, even though they said they didn't guarantee everyone, the fact that they backed the banks that went out of business, it sent a message that deposits were safe. And I think that really calmed the nerves back then. My biggest fear is the commercial real estate side of things. I also am very fearful of not only the amount of debt payments that the U.S. is having to make, but also corporate debt. You have about $1 trillion rolling over in the next 6 months that has to be basically financed. And again, we're talking about much, much higher interest rates. The question is, how many commercial properties are on the balance sheets of these banks? How much exposure do they have? And then right now, the residential real estate market is very strong. But what happens if something goes wrong there? And we start to see defaults there. So I think, again, the Fed always runs these stress tests. I think they're a little bit disingenuous. Personally, I don't think they really test the potential for what can go wrong. Because when things go wrong, it's not that one thing goes wrong and everything's fine. Multiple things will go wrong. And that's where you get these cataclysmic scenarios like we had in 2008, 2009.
Right. So one of the factors that at the time was driving interest into Bitcoin was this concern about traditional finance. And Bitcoin was the beneficiary of that trade. Bitcoin up, 75% year to date, currently at about 29,000. I know that the Bitcoin bulls do not like it when you say this, but you still think Bitcoin can drop significantly lower. I know big picture, big picture, you're very bullish on Bitcoin, but you still see a significant pullback for Bitcoin.
I do. And again, at this stage, the regulatory hurdles for Bitcoin at least have been passed, right? We know that recently we heard that Coinbase was asked by the SEC before they filed the lawsuit to stop trading in everything but Bitcoin. So Bitcoin is in the clear for regulatory purposes. But what I'm fearful of, and this is what I think could drive it back down to 15,700 or even lower, is if you get a liquidity issue, right? If you get a issue where the stock market does drop 20 or 30%, that's where I would be very concerned about Bitcoin price holding up. And we've seen it be rejected at this 30 to 31,000 level multiple times. I wouldn't want to see it break 27,000 is this trend line right here. If that gives way, it opens the door, the trap door essentially for us to go back down. And I'll just show this chart here. Let's flip this into two charts here. We have Bitcoin on one side, and I want to bring up the NASDAQ on the other. If we look at the NASDAQ from the all-time highs, right? So here's the NASDAQ. The NASDAQ, I think, is about 10% off of the all-time highs. Bitcoin is massively off the all-time highs, right? We're talking more than 50% off of the all-time highs. And so the idea is if you had the NASDAQ just go back to the October lows, and that's that big of a drop, do we really think that Bitcoin is not going to at least retest that 15,700 level when it's only this small of a drop here? And so I would dare say that if you got a bigger corrective move, if we went into a deeper recession, I do think that Bitcoin could potentially go even as low as my lowest worst case scenario, 9 to 10,000 before bottoming and eventually turning up in a massive way.
Right. But what you're showing, though, is that the correlation between Bitcoin and NASDAQ has actually reduced to a degree. I mean, the patterns and the charts look similar, but if you're saying, the NASDAQ is only 10% from its high, whereas Bitcoin is about 50% from its all-time high, doesn't it seem as though the correlation between the two is drifting?
Well, it still looks like there's a correlation. It's just that, unfortunately, the interest in Bitcoin has fallen dramatically and institutions are not stepping in versus over here, the NASDAQ clearly has been the recipient of so much money flow. So my fear is that with less interest in Bitcoin only driving it up this much versus where it was at the all-time highs and so much interest in stocks, if that were to reverse, do you see more panic hitting Bitcoin and driving it back to the lows? I mean, for all we know, maybe the NASDAQ only pulls back to 12.5, but Bitcoin just alone would then go back to the lows. So I think right now there's still a risk on, risk off correlation there with the stock market. But I do think eventually it changes and becomes the digital gold that we all hope it does. I just don't think we're there yet. People in the crypto industry are way too emotional for us to be back to be at digital gold yet.
But we do also have the potential BlackRock spot ETF coming through.
True.
And we have the halving in April.
And I would just say about that too is, interestingly enough, 2007's top on Bitcoin marked the futures launch of Bitcoin. 2021 marked the ETF on the futures, and then the BlackRock news this time on the ETF marked the short-term top. So it's interesting how these news events trigger tops versus what everyone is hoping for is the big breakout. Now, Just to be clear, I think the ETF is going to be a game changer. It's going to be a validation of Bitcoin to most retail investors, even older retail investors that don't have any exposure. But I just don't necessarily see that as a short-term catalyst versus the potential for downside via the stock market.
All right. So in your scenario, to end the second half of the year, you still see a really big correction happening in the equity markets second half of the year into the first quarter of 2024 and dragging Bitcoin down with it.
I do. I think that's ultimately what will happen, which will then create the bottom for the next big bull run in Bitcoin.
And you know, I always like to get your long-term Bitcoin forecast. Give me a 5-year Bitcoin forecast. Give the Bitcoin maxis some positive news.
I think 5 years out, you're talking at least 150,000. So I think, and that could be low end. I really do believe long term that it is the answer. And I think eventually the Fed is going back to printing. Heck, we even saw the Bank of Japan, after they talked tough and said, we're not going to do anything, they intervened and actually bought bonds like a day after saying they were going to YCC it, lose the yield curve control. So the Fed will be forced to because of the U.S. debt, and that's the only way is to print more money ultimately and kind of get things started. And that is ultimately the golden ticket for Bitcoin.
All right. Speaking of gold and golden tickets, you did go into this year saying you thought that gold would be one of the top performing assets. How's that shaping up?
Well, so far it's doing all right, but it certainly isn't the top performing asset. There's no doubt that the stock market and Bitcoin have far outperformed, but at least in terms of risk, you've kind of been able to cushion any sort of risk moves. Now, for me, this is a breakout short term on gold. We see this trend line here. We had a breakout retrace to what the scene of the crime is. This is a usual retrace, and now we're making another bull flag. I still think we take out the all-time highs on gold by year end, but again, it'll be interesting to see where the Bitcoin chart is and where the S&P is at year end to see, does gold pull it out in the last months of the year or not?
Well, we are seeing that the December futures contract is actually the most actively traded one and is doing very, very well. Yes. I think it's around 2,000 at the moment, which is a disconnect from where we are with gold at around 1,900, 1960 more or less. So you see that sentiment towards the end of the year as the world starts to show signs of cracking, as this recession idea starts to really take hold. That's where gold comes in.
I think that's exactly right. And in fact, that makes sense that we're trading there, because if we look at the US dollar, the dollar here, the Dixie, it broke down from a long-term trend line of support. It did a classic retrace today, in fact, hitting the scene of the crime right here. But this is a longer-term trend break on the dollar, and a weaker dollar is good for gold. I also think that it's probably a scenario where we're getting closer to a recession by year end, and the Fed may have to think about lowering rates, which is also positive for gold. I also think inflation still remains slightly elevated in that scenario as well, which is also good for gold. So I do think by year end, you're seeing a very good pop on gold.
All right. So gold will still hit a new all-time high in 2023. To be clear, it did make a new all-time high in terms of how it trades on the COMEX in May at around 2,083, but a real all-time high for gold by 2023. You're sticking to that. Now, Gareth, I know that there is another commodity that you're very, very bullish on, and that is uranium. Make your case for uranium.
All right. So chart-wise, that's my bread and butter here. You have a long wedge pattern here on the chart. Take a look at that. And again, look at what's happening. We've hit this line or kissed this line multiple times. Just in the last few days, we've started to pop above on the URNM. This is the Sprott Uranium Miners ETF. And the case here is very simple, is that, we're seeing record temperatures all over the globe. There's going to be more and more people calling for alternate energy to gas, coal, and oil. But to be honest, it's not feasible to make enough solar panels, or is it cost effective? So I think there's going to be a new push for uranium and nuclear power plants. In fact, I think one just came online just in the last few days. And I think that is potentially the next big trade here, with inflation elevated or staying elevated. Look at the uranium side of things. I think it's a potentially great trade here.
Yeah, on that front, as you mentioned, a nuclear power plant in Georgia entered commercial operation recently. It's the first new American reactor built from scratch in decades. Georgia, very big into nuclear power, makes up about 25% of the generation of power in Georgia. And we've also got a continued geopolitical instability obviously the Russia-Ukraine conflict, but Niger, which is a top uranium producer, I think it's number seven largest producer of uranium in the world, they're having major political strife there with the coup that we saw in Niger last week. So if that volatility continues politically, that's also a short-term driver for the price of uranium. So what would you say is the percentage upside for this uranium trade? How much upside is there?
Yeah, I mean, just looking at the chart, and again, we could go much higher than the highs on the chart, but I think a revisiting of the high from 2021 is very possible. So, I mean, you're talking potentially 50% upside here on uranium just maybe in the next 12 months.
Okay, and how does that fit into the recession concern? How does that fit into a slowing economy?
Yeah, I think it's somewhat immune because again, it's not so much oil and oil consumption, but it's the move, the political move, the pressure to move to a sustainable alternate to oil and gas, and I think that's going to be gaining momentum. The more and more people, I mean, again, hearing about Arizona's heat wave that they've been through in some of these other areas, and even in the Arctic and so forth, there's going to be more and more pressure all over the globe to move towards uranium or nuclear power. So I don't think it's going to be as affected by a global slowdown as people might think. And I think it's a very good place to potentially even protect yourself in.
What about a potential slight shift in the ESG narrative? We know that BlackRock, the world's largest asset manager, now has named Aramco CEO Amin Nasser to the board. So that's a very big move considering that's Saudi Arabia's oil producer. World's largest oil producer, in fact, owned by the state of Saudi Arabia. Larry Fink, who has really embraced the ESG mandate and has really been pushing companies that he invests in to adopt ESG. He's indicated that now there should be a choice of how to approach the energy transition, that's up to every asset owner. He's also indicated that there is room for oil and gas in the economy. Do you see that indicating a shift in the ESG narrative coming from BlackRock, and what impact would that have?
Yeah, I think anything that BlackRock does, you have to take note of because they're such a massive, player in the financial industry. So I think it is interesting, and I do think there's this switch. I think geopolitically, there's a huge shift here away from the need to always be on this ESG side to being more of a balanced portfolio and kind of looking at all sides. And I think again, the political spectrum in the U.S. shows that it's 50-50 at this point. So you got to handle both sides of it.
Right, but does that mean we'll get more investment going into energy companies again? Does that mean that in a way it pulls investment away from clean energy resources?
Yeah, so one thing I do think is that you'll see a lighter touch by the administration over the next 12 months going into the elections on oil restrictions and drilling, just because, again, it's politically advantageous to lower oil prices. So I think that's part of it. And I do think that, ultimately you'll see more investment in oil and gas. Absolutely.
All right. But uranium, you say, is the trade, and the spot ETF is the way to do it.
Yeah, and I think that the key is here is oil's already run up, right? I mean, not to say it can't go to 90 or 95, but I always look for things that are just starting their moves because the risk reward is greatest there. And right now, uranium is tops for me.
Yeah, we've actually had a few guests on the show to highlight that uranium could be a big opportunity here. All right, Gareth, we're going to wrap up. But before we do, tell our viewers what they can expect from you with regards to the game plan that you have every Wednesday morning.
So not only every Wednesday, but I started with earnings season doing it every morning at 9 a.m. You can find it at verifiedinvesting.com, on my YouTube, on my Twitter. And basically, I do 20 minutes. It's a hardcore kind of inside dive into the markets for that day, the earnings, the charts, what levels are looking good, everything you need essentially to trade the markets, to trade the commodity markets, the crypto markets, and the stock market for the day. So I'm having so much fun doing it. I probably will continue on a daily basis even.
All right. Game plan with Gareth Soloway on a daily basis, giving you your short-term trade ideas for the day. Of course, we love to get your long-term, big macro outlook here on Kitco. So thank you for sharing that with us. We will be touching base with you again, I'm sure, over the next couple of months. Gareth, always great to have you. Appreciate it.
Thank you, Michelle. Have a wonderful day.
All right, you too. And as always, a big thank you to our sponsor, Prime XBT, which, as a reminder to our viewers, is an award-winning cryptocurrency trading platform that allows you to trade global markets, including crypto, commodities, indices, and Forex. And there is a special offer for Kitco viewers in the description of this video if you're watching us on YouTube. All right, so for me, Michelle Makori, and the rest of the team, thank you again for watching, and we'll see you next time.
Begin your path to financial freedom. Gain up to a $7,000 bonus on us. Register and use promo code. Deposit and enjoy a 7% bonus. Available now. Link in the description.